Hi there. Let us start Unit 5, which is nothing but swaps. I think you all know what are swaps because uh, since from starting of this subject, we are discussing what is a derivative and what are its types. And last type in the derivatives is nothing but swaps. Swaps are contracts between parties to exchange cash flows in future, right? So in short, swaps are contract between the parties to exchange cash flows in future on specified future date based on the currency exchange rate. Okay, so if one party's financial instrument for those of other parties financial instruments means for financial instruments to financial instruments the exchange will take place. Okay, swaps are the contracts between the two parties exchange of cash flows in future means as same as in the case of forwards or futures or options. So on a specified future date, but it is based on the currency exchange rate. So why? Because here, so the financial instruments are going to be exchanged for financial instruments. So in past types of derivatives, if you see the financial instruments are exchanged for money or some other means. Here, the financial instruments will be exchanged for the financial instruments. That's why we are calling it as swaps. So just exchanging the financial instruments from one party to another party, just swapping the financial instruments from one party to other party. That's why we are calling this as swaps. So swaps are the contracts between the parties to exchange cash flows in future one of the party of one party's financial instruments to other party's financial instruments. So here we are mentioning financial instruments. So what are those financial instruments means all those equities or stock or sometimes the stock exchanges, the commodities like salt, pepper, crude oil, gold, silver, and all those things will be exchanged. And here we have different types of swaps also. There are interest rate swaps, currency swaps, equity swaps, and commodity swaps. Here in the case of financial instruments, you can consider this also. If the financial instrument is interest rate will be exchanged with the interest rate of one party to another party. And currencies of one party to other party is exchanged. And equities of one party to other party will be exchanged at the same time. Commodities of one party to other party will be exchanged. So we can consider the financial instruments as interest rates, currency swaps, equity swaps, and commodity swaps. So that's why we are calling it as that's why we are calling this as types of swaps: interest rate swaps, currency swaps, equity swaps, and commodity swaps. Okay, these are all the types. So now let us see the features of the swaps usually. What would be the features? Swaps do not involve an upfront cash payment from one party to another party. As I mentioned, here one party's financial instrument will be exchanged with the other party's financial instrument. So there won't be any exchange of cash payments. Means no cash payment will take place between the parties. Swaps do not involve any of the kind of cash payments from one party to another party. And one more feature is swaps are extremely customized. They are customized. It is according to the customer. So no basic structure would be there. It is according with the requirements of the customers. So swaps are exclusively customized, and also they are OTC instruments. So OTC means over the counter. Over the counter means so which do not involve any kind of intermediary. So intermediary won't be involved. Intermediary, who is intermediary here? A stock exchange or a statutory body which is having certain rules and regulations or certain conditions to do trading. So swaps are exclusively customized, and they are OTC instruments means they won't trade in stock exchanges. They are going to be traded outside the stock exchange. So the two parties, and the other feature is the two parties are usually a dealer, which is a financial instrument that makes and market swaps to an end user customers, right? So there will be two parties. Usually one will be the dealer and other will be the one will be the dealer, which is also a financial institution, and other will be the end customer. So customer to the dealer or customer to the financial institution. So that will be the two parties involved in a swap, and no intermediary will be involved like options or like futures. In futures, if you see, in between the buyer and the seller, an intermediary will be involved, and also in options also, in between the buyer and the seller, an intermediary will be involved. So but not in forwards or in swaps. So swaps and forwards or OTC instruments, means over the counter instruments. Okay, swaps are subjected to default risk. Swaps are subjected to default risk. We all know that what is a default risk. So means counterparty risk. As it is an OTC instrument, over the counter instrument, no statutory body or no intermediary or no stock exchange will be involved between the buyer and the seller. So counterparty risk will be existing, right? If other party become defaulter, or if he is abscond, then in such cases the default risk will rise, right? So swaps are subjected to default risk. By default it is having this risk because it is an OTC instrument. Swaps are financial instruments came into existence due to the presence of exchange controls which restricted the movement of the capital from one country to another country. So actually it would be the origin. If you see the origin of the swaps, why swaps were started means, so if you see one country exchange of capital or exchange of money from one country to another country is becoming difficult, right? In past days it is a difficult thing to exchange capital or movement of capital from one country to another country. It is having certain restrictions, certain controls, right? So to avoid those controlled restrictions, so swaps are introduced. Suppose if you see to which country we are moving the capital, we have to see. Suppose for example to US, if you want to move your capital, now you will see which is a subsidiary that is existing in the present country, and based on that, based on the subsidiary, you move your capital. At the same time, US wants to move capital to India, so US will check where it is having a subsidiary of India's company. So like how movement of capital would become easier. Okay, so that is the main reason for swaps to come into existence, in order to control or in order to overcome the restriction on movement of the capital. Okay, let us see the evaluation of swaps. As I told you, because of these reasons swaps has been introduced. So necessity is the mother of invention. So because of that necessity, exchange of controlled exchanges or restricted movements of capital leads to invention of this. And evaluation of swaps as a financial instrument is based on this proverb, based on mother of invention proverb. And third one, financial experts believe that swaps developed out of the constraints and regulatory controls faced by large corporations in 1970s. So when MNCs operating in various countries could not remit fund back and forth among their subsidiaries due to exchange controls, they come out of the innovation of this back-to-back or parallel loans among themselves. Means here, uh, the financial experts, means whenever they are studying about these swaps, they felt that so these were developed based on the constraints and regulatory controls over the exchange or over the movement of the capital in 1970s. So in 1970s, so they found this constraint or this restriction to movement of capital. So they have come with a new thing like back to back or parallel loans among themselves. So giving back to back loans, giving parallel loans among one country to another country will leads to overcome this restriction, right? So now what are these back to back or parallel loans? So why what it will remove? So these remove the difficulties of capital flow, and in full fledged this these back to back and parallel loans was converted into swaps. So initially they started with back to back loans and parallel loans. Later on, these, by just modifying some of the aspects in back to back and parallel loans, so the swaps were generated or the swaps were developed. So now let us see what is the mechanism under these parallel loans. Okay, so parallel loans involves four. Take an example. If it involves four parties, in four parties, two are MNCs and two are subsidiaries in two different companies, right? So here the MNC companies were belong to, one is USA and other one is London. Now take two locations, USA and London. So now take one company, IBM, which is in USA. Suppose if that IBM is having a subsidiary in London, and take one company in London, which is British Telecom. Example, for example, it is British Telecom, and if it is having a subsidiary in USA, right? So now if IBM wants funds, if the subsidiary company of IBM in London wants funds, so they'll tie up with this British Telecom. Suppose if IBM means the subsidiary in USA wants funds, or if it wants to raise money, or if it wants to move the capital, then it will have a tie up with this company in USA. So like how they'll have parallel loans or back to back loans, they'll share among themselves. They won't move funds from one country to another country. The funds won't move from won't move the borders, right? Within the country itself, they'll arrange the requirements of their capital. So that is nothing but the parallel loans or back to back loans. Okay, so here both the subsidiaries require funds in their respective countries, and because of these regulatory controls, neither IBM nor British Telecom can exchange their funds. So because of that, back to back or parallel loans has been started, right? So once if they took these back to back or parallel loans, so the amounts will be re-exchanged at the maturity date, which is determined in advance. Whenever they are taking this back to back or parallel loans, so they'll re-exchange the money at the end of their determined date. Okay, so that is the mechanism which is underlying in these parallel loans or the back to back loans. Beside this, the regulatory control, there are other economical advantages because of these swaps. So full blown financial, if this once the swap was developed as a complete financial product, so which remained popular and even after the removal of regulatory control also. So though regulatory controls regarding the movement of the capital was removed, but still people are using swaps in order to exchange the money from one nation to other nation. So swaps has gained its own reputation. So that's why though regulatory control has been removed, swaps were using. Okay, so now let us see, these are all this is the evaluation of the swaps, how it is originated and how it become a completely used financial product in the markets. Okay, so I think you all got it, what is a swap and what are its features and its evolution. Okay, so now let us go to the other concept, the next concept, that is types of swaps, and that the first type is interest rate swaps. So in interest rate swaps, what is an interest rate swap? First of all, if the exchange of cash flow is done on the basis of interest rate, so then we call it as an interest rate swap. As I told you when I'm explaining about the swap, the financial instruments will be exchanged of one party to the other party. So here the financial instrument that we are exchanging is interest rate. Okay, so if the financial instrument exchanged between the parties is interest rate, then we call it as an interest rate swap. If the exchange of one minute, sorry for the disturbance. If the exchange of cash is done on the basis of interest rate uh, prevalent at the relevant time, it is known as interest rate swaps. Interest rate swaps are categorized into two types. So they are fixed to floating and floating to fixed. You all know how the interest rates will be calculated and types of interest rates. It is of two types: fixed interest rate and floating interest rate. Fixed interest rate means the interest rate will be fixed throughout the period, and in floating interest rate, so according to the changes in the market, the interest rate will be changed. So that is floating to fixed. So now let us see what is happening in fixed to floating. In fixed to floating, uh, floating rate swaps, so the party pays a fixed rate of interest to the bank or a swap dealer. So it will pay at the party, means the end user will pay either to the bank or the swap dealer according to the agreement with whom they have done. If they have done with the bank, they'll pay to the bank, or if they had done with the dealer, they'll pay to the dealer, right? In fixed to floating rate swaps, the party pays a fixed rate of interest. So first, fixed to floating, right? Fixed rate of interest to the swap dealer, and in exchange it receives floating interest rate. Okay, so the end user is going to pay fixed interest rate and going to receive the floating interest rate. Whereas in floating to fixed, in this the party pays floating rate of interest to the bank or swap dealer, and in exchange it receives a fixed rate interest rate at the determined intervals of time. So the reverse of that. So the end user or the party, suppose if we are taking the swaps, so we will pay fixed interest rate and we will receive fixed sorry we will pay floating rate of interest and we will receive fixed rate of interest. And in the case of fixed to floating, we will pay fixed interest rate and we will receive floating interest rate. So that's what the difference. It's very easy for you to remember fixed to floating and floating to fixed. So now let us see what are the features of these interest rate swaps. So the features of the interest rate swaps are: the first feature is series of cash flows, as I mentioned here determined at intervals of time. So whenever we are undergoing the contract or the agreement, so we'll have a fixed time period and we'll have a fixed intervals of time, right? So it is having the series of cash flows. The swaps involve a series of payments in exchange of receipts at the same time, means we will pay at the same time we will receive. That's why we are calling it as swaps, right? So we will pay at the same time we will receive, and the transaction do not end with a single cash flow, but it is having multiple cash flows. Suppose if the time period is for 3 months, 6 months, 12 months, based on that, based on the time interval we have chosen, we are going to pay the money and we are going to receive the money, right? Series of payments and a series of receipts that is going to happen. So that is one of the feature of the interest rate swaps. And the second one is notional principal value. Notional principal value is nothing but the amount that is to be exchanged at that particular point of time. Okay, it is not the principal amount. Actually, principal amount means at what amount we are agreed to exchange, but notional principal amount means, so the present value, the spot value of that money, that present value of the money or the spot value of the money will be considered, and that will be considered as uh, that will be the major criteria that we consider whenever we are calculating the interest rates that to be exchanged between the parties. Okay, so that is notional principal value. And one more feature is only differential cash flows is exchanged, means the differential amount is exchanged between the parties, yes or no? So if one is paying fixed and other one is if one is paying fixed and other one is paying floating, so means there will be differences in the amounts they are going to receive. So in a long run, if one is one if one has lost certain amount by fixed rate, so that will be compensated in long run. So if one is gained certain amount by floating rate, that will be compensated with some loss in the future. So that's why fixed to floating and floating to fixed will be done for the exchange in interest rates, so that both the parties will gain at some point. Okay, so these are all the features of the interest rate. Now let us see how the pricing and valuing of interest rates will takes place. Interest rate swaps will takes place. So the value of the swap, how will you get the value of the swap? Means the present value of fixed rate swap minus the present value of the floating rate swap. Fixed minus floating. So in short, in diagrammatic, in mathematical representation, Vs is equal to Vc minus Vf. So Vs is value of the swap, Vc is value of fixed rate swap, and VF is value of floating rate swap. How do you get this fixed rate? Fixed rate swap. Here I mentioned leg. So every interest rate, every swap will have two legs. One leg belongs to the receiver and one leg belongs to the payer, right? So if that concept is applied in these interest rate swaps, the value of the swap here, the interest rates, the fixed interest rate will be the one leg, floating interest rate will be the other leg, right? So the value of the fixed interest rate leg will be calculated by using this formula. We all know this formula. If you see, this is the formula for valuation of bond, right? We feel that the exchanges, the things exchanged between one party to another party as a bond. So we use the formula of bond. Okay, how do we calculate that bond value? Sigma I equal to 1 to n Ci by 1 plus Ri whole to the power of n plus P by 1 plus Rn whole to the power of n. Okay, here P is, here the values of this C and P will be changed because it is of interest rate swaps. P is notional principal amount and C is coupon payment, and is number of periods remaining. Suppose if it is for 5 periods, if 2 periods was already done, if it is asked to calculate for you remaining 3 periods, though, so the number of periods would be for you is 3. So like how you have to calculate. R is the discount rate. So the fixed interest rate leg VC is equal to sigma I equal to 1 to n Ci by 1 plus Ri whole to the power of n plus P by 1 to the power of 1 plus Rn whole to the power of n. So this is the formula for fixed interest rate leg. Similarly, the value of floating interest rate leg Vf is equal to F by 1 plus R1 plus P by 1 plus R1. Means here why we are considering only one term means it is of the value is fixed, right? The value is fixed. So F is the next payment of interest, R is the discount rate, and P is the notional principal value. So now as a whole, we just combine these two formulas, we'll get this. Vs value of the swap is equal to sigma I equal to 1 to n Ci by 1 plus Ri whole to the power of n plus P by 1 plus Rn whole to the power of n minus F1 by 1 plus R1 minus P by 1 plus R1. So this is the standard formula for calculation of interest rate swaps. So I gave you an example also here. A firm entered 5-year interest rate swap, receives 8% fixed and pays MIBOR. So MIBOR is nothing but MIBOR and LIBOR is the standard values that we follow for interest rates, plus 1% and 3 remaining annual payments. So the structure of interest rate is given as below. For 1 year it is 10%, means for remaining 3 periods it is given. For 1 year 10%, 2 years 10.5%, 3 years 11% is given. So now we have to find the value of the swap. So how do we find the value of the swap? Means just we assume nothing was given, the data only interest rate. So we consider the value of the bond as 100. So based on the 100, we'll apply these interest rates. So these interest rates like 10% or 10.5, 11 or 8%. So that we consider. So by using the discount rate is 9.5%. So the principal notional value is 10%. So based on that, we calculate the value at the floating rate and the value at the fixed rate. So just substituting F 9.50, 1 plus R is 0.10, 100 by 1 plus 0.10. So you will get total, the value of the floating rate is 99.5.45 and value of the fixed, it is based on the time period 1 2 3. Here it is fixed only one time period because it is fixed, and now here it is 8 by 1 plus 0.10 for the first period, 8 by 1 plus 0.105 for second period, 8 by 1 plus 0.11 for third period, right? So finally the total notional principal value plus the third year's interest rate. So then if we calculate all these things, we'll get 92.793. So the value of the swap would be minus 6.52. Means the firm A, suppose if we consider this is an example for a firm A. So a firm A will have loss during the loss of this much percentage during the entire 5 years. Okay, so this would be the structure. Suppose if the example is taken between Intel and Microsoft, so one is having fixed interest rate and other is having floating interest rate, and that will be exchanged between this Intel and Microsoft. Okay, right? This is interest rate swaps. I think you all understood what are interest rate swaps. So just I'll summon this session by explaining you again what we have learned in this session. What is a swap? Swap is nothing but a contract between two parties where financial instruments will be exchanged between one to other. The types are interest rates, currencies, equity, and commodity, and no cash payment will be involved, and it is an OTC instrument. And to the end customer, the other party will be the financial institution or the dealer or a bank. Okay, there will be default risk in swaps, and this swap was evaluated because of the presence of restrictions in exchange controls of movement of capital from one country to another country. Because of that, so the swaps were evolved, and initially back to back loans or parallel loans has been started. So later on, these back to back and parallel loans was full-fledgedly converted into financial product, which is nothing but swap. Swap gained its reputation, though the financial controls has been reduced. Swaps are still we are using, and under that, the first type of swap is interest rate swap. Interest rate swap, where the financial instrument here exchanged between the two parties is interest rate, and it is of two types: fixed to floating and floating to fixed. One will pay in fixed and other will pay in floating. And series of cash flows and notional principal value and differentiated cash flows are its features. And the value of fixed rate, the value of the swap we are going to get by present value of the fixed rate swap minus present value of the floating rate swap, so that we are going to get the value of the swap. The structure will be one is paying fixed and other will be floating. And in the next session, we'll discuss the currency rate swaps. For this session, we end up to here interest rate swaps. In the next session, we discuss about currency rate swaps and other things also. Okay, thank you.